Welcome to a new earnings review video, but this is not going to be your usual earnings review video. This is going to be quite different, and I think you're going to like it because we're going to talk about the macro conclusions from the earnings that we got. You see, a lot of folks can have an opinion about the economy, and there's a lot of research been going on. Some folks would say, oh, the consumer is strong, and therefore the economy is good. Others would point out the housing market, for example, and say that the economy is weak. And there's a lot of confusion about the state of the economy and who to trust really about the outlook and what's going on in the economy right now, because we have a lot of political biases. Now, a lot of folks will just give you a rosy picture if they happen to have a certain political bias, or they're going to give you a doom and gloom picture if they have a different bias. Here, in this video, we're going to look at the facts, and that's it. And what's better to understand the economy than looking at corporate earnings, what they say about the state of the economy and the themes going on in this economy. And folks, understanding these themes is not only going to help you understand the economy, but also going to help you understand how to invest in certain themes. Whether there are certain themes you need to short, certain themes you need to be long, that's what corporate earnings are going to show you. So without further ado, let's begin with the first theme that we can find from earnings, which is consumer weakness. And the evidence behind that is Chipotle's earnings. We talked about Chipotle's earnings in the previous video just briefly, but the most important finding is comparable sales for Chipotle went down by 4% year on year. Now, this is one of the highest growth companies in the restaurant field, and it seldom shows a decline in comparable sales. I think we've only seen that during the pandemic. But to see it right now is a bit alarming, because if Chipotle's consumer, which we think is more resilient, is facing weakness, then what's going on with McDonald's consumer, for example? What's going on with other restaurants' consumers? And the beauty of comparable sales, it can show you something different than if you look at the revenue. So you can assess the health of a company. In this case, Chipotle. You could look at the revenues going higher 3% year on year and say, well, I don't see the problem here. The consumer seems to be spending, otherwise the company would not make higher revenue year on year. But that could be due to the inflationary increase in pricing by the company. What we want to know is the volume of sales. Are more consumers showing up or less? And that's what comparable sales are going to show you. And in this case, when we have revenue going higher, 3% year on year, but comparable sales down 4%, what does that say? The volume of diners going to Chipotle or buying meals from Chipotle is actually declining. But we also see price increases, so the consumers who are still dining at Chipotle are paying more. And hence, we see the increase in revenue. And here's the evidence. You look at what Chipotle said, that comparable restaurant sales decreased 4% due to lower transactions of 4.9%, partially offset by a 0.9% increase in the average check. So that's the proof that we have lower transactions, less customers are showing up, but those who are showing up are paying more. You might have noticed also in the same page right here at the bottom, it says that labor costs in the second quarter of 25 were 24.7% of total revenue. That's an increase from 24.1% from last year. And this is probably going to get worse for Chipotle because of the minimum wage labor issues in California. A lot of restaurants can't really afford to pay the minimum wage by the state of California. Now, the problem for a company like Chipotle and many companies in the restaurant business right now, if they're seeing less volume, but they're charging the consumer who's still dining more to make up for that, how long can they continue to do that? How sustainable is that? Because if there is general weakness in the economy, it might impact the existing consumer who's paying more right now. And if labor cost continues to rise higher, then the ability of a company like Chipotle to continue to increase the pricing on their existing consumer would be limited, because they don't want to lose consumers. At the end of the day, you reach the conclusion that with the weakness that we see in the consumer, a lot of companies in the cyclical side of the economy like Chipotle will have sooner than later to accept lower margins. And this is, by the way, not just stemming from the increase in labor cost. Bear in mind that some of the increase that we see is not Chipotle doing price gouging, but it is of necessity, because the prices of beef have been skyrocketing at all-time highs right now. So it costs Chipotle a lot to provide the beef, and they have to charge more for it. What if they can't do that anymore? Because more and more consumers are getting weaker. Take a look.
Price of beef is skyrocketing to a record high. And here with a closer look at the impact, NBC senior business correspondent Christine Romans. Christine, good morning to
morning.
you.
Good morning.
First eggs, now beef.
I know.
What happened to the steak and eggs breakfast?
I know. Look, it is a noticeable jump. You've got ground beef above $6 a pound for the first time in history. The government has been following these numbers for a long time, above $6 a pound, up almost 12% from last year. And steaks, you've probably noticed, almost $12 a pound, up about 8%. The American Farm Bureau Federation saying that there's really strong demand. The Tyson, the meat company, saying it's a challenging beef environment here. So you have noticed, and the government says they expect beef prices to rise, beef and veal prices to rise almost 7% this year.
So why the spike right now, Christine? What's behind this?
You've got smaller herds. You've got fewer family farms. You've got 7% fewer farms since 2017. You've got inflation and high interest rates making a very challenging environment.
The second theme is weakness in the housing market. And this is evident by D.R. Horton's earnings this week. So here's the headline for you. It says pessimistic home builders are offering outrageous incentives to lure buyers. In other words, demand went down, and these home builders have a lot of homes that are available right now, but they can't sell them. So they have to offer incentives, discounts for consumers to buy them. You can extract two things from this dynamic. Number one, we have weakness in the housing market because consumers are getting weaker. Potential buyers who were saving some money to buy a home are now have to deal with credit card debt and a lot of insecurity about their income. Maybe their job's going to be replaced by AI. So they have to be really, really careful not to spend that stash that they originally had for buying a home. And maybe they're dipping into that stash. Not to mention, of course, the mortgage rates are still way too high. So we have this weakness in demand in the housing market. And to meet that weakness in demand in the housing market, companies, home builders like D.R. Horton, are having to incentivize buying by reducing the price of homes. We've actually gotten to a really weird phenomenon, which is the price of a new home right now is actually lower than the price of an existing home, which, by the way, anybody who's sitting in a home right now, at some point they're going to have to wake up to the fact that you're not going to be able to sell your house at this price. You have to cut it. Now, this is good from an inflation perspective because housing is a huge component of spending. And if we have cutting in prices in housing, that's pretty good for the inflation picture. But what it's not good for is the margins of these home builders because they've paid a lot of money to build these homes under inflation prices in 22 and 23, 24. And now they can't really meet the demand. They can't see demand in the market, so they have to eat a loss on it or eat a lower margin than they've anticipated before. So we see the result right here. D.R. Horton trims the high end of the 2025 revenue outlook as results weaken. Listen to this. The Arlington, Texas company logged in net income of $1.02 billion, or $3.36 a share for the third quarter ended June 30, down from $1.35 billion, or $4.10 a share in the year-on-year period. Analysts polled by FactSet had expected a $2.89 a share. So beating the analysts, but not beating the results from last year. Revenue declined to $9.23 billion from $9.96 billion. The analysts were expecting $8.75 billion. Homes closed in the quarter came at 23,160. That is a 4.1% decline from the 24,155 homes that the company managed to sell or close in the year prior. Most importantly, D.R. Horton management says, we expect our sales incentives to remain elevated and increase further during the fourth quarter, the extent to which will depend on the strength of demand during the remainder of the summer, changes in mortgage interest rates, and other market conditions. Again, good news if somebody wants to buy a home, that you can get it for a cheaper price than before, but not pretty good for the company. And if the discounts and the incentives right now are not enough, they're going to have to do more of that. And the problem with that is it shows a picture in the housing market that demand is collapsing. So we can say it's good to a certain extent, such as if the home builders reduce prices by, let's say, 2% or 5%, including incentives. And all of a sudden we see a surge in demand, and that's a good thing. But if we see them discounting and demand not increasing, that is a huge problem and a warning sign that the housing market and the economy is beginning to collapse. Listen to this. The spring buying season, when builders make close to 40% of their annual sales, is halfway over. Based on earnings released by listed builders, demand has been disappointing. America's biggest builder, D.R. Horton, said revenue fell 15% the latest quarter compared to a year ago. PulteGroup sales dropped 2%. This is before the pain of tariffs is really felt. Builder LGI Homes said this week. So huge problem in the housing market. I understand that the stocks reacted positively because things came out better than what the analysts were expecting. But to be honest with you here, if this continues, the incentives continues, the margin is going to be reduced. This is going to be a net negative for the home builders. The third theme that we can extract from this week's earnings is the impact of tariffs. There's a lot of debate out there, which it shouldn't really. It should be straightforward. If you have tariffs, either the seller of the good is going to pay the tariff at the port, aka eat it, or they're going to pass the extra cost down to the consumer and cause inflation. It's one of the two. Really straightforward. But we have a lot of folks online who are saying, oh, but see, we're not paying the tariffs. Nobody's paying. China's paying the tariffs. EU's paying the tariffs. Canada's paying the tariffs, which we all know is false. You know why? Because GM, the company that Trump is supposed to rescue from unfair trade arrangements with other countries, is now the one that's getting hit by the tariffs. Take a look.
Tariffs are obviously a big story for us.
General Motors today said the price tag for President Trump's tariffs was $1.1 billion in the second quarter.
We don't expect any specific price increases related to tariffs.
GM so far eating the tariff cost, trying to offset some of it through cost cuts and investments in the U.S.
Many of the manufacturing announcements that we made earlier in the quarter about onshoring production here into the U.S. with $4 billion of capital initiatives are going to have an effect as we get 18 to 24 months down the road.
But the current 25% auto tariffs, hard to avoid. GM says they will cost the company $4 to $5 billion this year. Other automakers feeling it too. Jeep and Chrysler maker Stellantis says, due in part to tariffs, it expects a $2.7 billion loss in the first half of the year.
Now, there are good things that could happen from this trade dynamic in the long run, such as if General Motors, for example, decide that, hey, wait a minute, if we build the car in Mexico or Canada, we're paying 25%, but a car made in Japan is going to be tariffed at 15%. We're going to lose a lot of market share in the U.S., so we have to move manufacturing back domestically. That's the positive news in the long run, if they decide to do that to begin with. The negative news is it will take huge investment by GM to move manufacturing back in the U.S., and in the meantime, they're going to eat a massive, massive loss as they continue to lose market share while they shift production back in the U.S. Number two, it will also increase the cost for consumers. The reason why GM is producing cars, or building cars rather, in Mexico or Canada is because the cost is lower. Now, if they're going to have to build it here and pay American wages and the transportation of the metals and the equipment that they get from Canada, that's going to increase the average cost of price for GM or Ford car. And again, that's not pretty good for the U.S. auto manufacturers. They're going to be at a disadvantage now, in between, and even after. But this is the first example that we got, the proof that American companies, American businesses are paying the tariffs. It ain't China, it ain't Japan, it ain't the EU, it ain't Mexico. Now, the fourth theme, perhaps the positive theme, a most important theme for the market and the economy right now, is AI spending, specifically by the big technology companies. And the evidence from that comes from Alphabet's earnings that we talked about in details over the week. But you can see that spending, the CapEx by Alphabet, has increased quarter on quarter from $17.2 billion to $22.5 billion. So the pace of spending on AI by these large cap companies not only increasing, but it's being boosted now. And it's not the case that increasing spending on CapEx by Alphabet is hurting their bottom line. They're actually increasing revenue too. So the dynamic for the largest and wealthiest companies in America is pretty good. And they're still spending billions of dollars. And in the AI bubble sphere, that spending keeps a lot of businesses alive, and it keeps the stock market alive. Why? Because these are the largest companies in the world. And that's what really matters when it comes to the weight of the stock market index, is if these companies do okay, we don't really care about what the other 493 companies or 490 companies, whatever math you want to use in the S&P 500, if they all do pretty bad, but these big, large, weighted companies do okay and they continue to spend, then the market is going to hold. And if the market holds, what is that going to do? Increase the wealth effect in the economy, specifically among the affluent consumer. And we will talk about that in a minute. But the fifth theme that we got from this week's earnings is the weak demand by federal government employees, as we see the layoffs from Doge and such, and also the weak tourism season. And we can see that evidence from Hilton's earnings this week. Now, this report was not bad by any means, but you can see here, if you look at the occupancy for different regions. In the U.S., it went down 1% year on year. Likewise, if you look at the average daily revenue, that also went down year on year. Most importantly, the revenue per available room, RevPAR, went down by 1.5%. Every other region, excluding the US, had positive RevPAR. So to what do we attribute this negative growth in the US region for Hilton? Here it is. I'm highlighting for you here that they say even with modestly negative top-line performance, given the holiday and calendar shifts, reduced government spending, softer international inbound business, and broader economic uncertainty. So when you have cuts by DOGE and cuts in the federal government, those employees are not spending anymore, they're not traveling anymore, they're not booking hotels anymore, they're not booking flights anymore. And at the same time, if we don't have tourists coming to the U.S., then Hilton is going to lose a lot of business domestically because they depend on the tourists coming in. And right now, they don't want to come here. So that's a negative for Hilton right now. Moving on to the sixth theme, which is unemployment. Where do we see that? How about Intel? A lot of folks say, Mav, the economy is different than the stock market. I disagree. And I have the evidence. Just look at the correlation of unemployment announcement by a certain company and the stock performance. When the stock goes down, we see higher announcements of unemployment. And the evidence here is Intel. The stock hasn't been doing pretty good. The company hasn't been doing pretty good. And now they're cutting about 15% of its staff as it pushes to make a comeback. I highly doubt they're going to make a comeback. And it's a lesson for a lot of investors that you can have one company at the top of the world at some point, and then it becomes obsolete a few years later because the disruption cycle in technology is getting shorter and shorter and shorter. What it used to be 20 years got reduced to 10 and now to 5 years, and it's kill or be killed. If you fall behind the game, you're going to end up being Intel. What are the economic ramifications of such huge layoffs by a major company in the U.S.? Take a look.
We have some breaking news from Intel. Intel now expected to lay off over 2,000 Oregon employees. The Intel layoffs are expected to be much greater than initially expected. That is not good news. According to a WARN notice released just today, an hour or so ago, the Semiconductor Manufacturing Corporation is going to lay off 2,392 employees at these 4 Intel locations in the Portland area on Tuesday, July 15th. So much more news. The Intel layoffs here in Oregon, much larger than anyone was expecting. We'll continue to follow that story closely.
It's the latest hit for Intel workers in Oregon, the state's largest private employer. Last year, they cut around 3,000 jobs, according to the Oregonian. Tech experts say Intel has fallen behind other companies in the semiconductor race, especially as artificial intelligence technology booms. Intel says they're trying to position the company for the future, writing, quote, "We are taking steps to become a leaner, faster, and more efficient company. Removing organizational complexity and empowering our engineers will enable us to better serve the needs of our customers and strengthen our execution." Intel still has around 20,000 employees in Oregon, but the news has many thinking about the ripple effects, not just the 500 workers laid off, but the property taxes they pay, the schools their kids go to, and other businesses in the community who rely on Intel workers.
So what was announced so far is 5,000 jobs across the U.S. are now cut. The majority of these jobs are, of course, in the state of Oregon. As a former Oregonian myself, I would say that the state's economy depends hugely on Intel. And if you see mass unemployment like this, if you see layoffs by the thousands, as the reports suggested, the ripple effect will be what we really have to worry about. We all know that Intel is doing horribly and falling behind in the AI war. Got it. That's the problem for the company. It's already priced in. We already know about it. But if the solution by Intel is to lay off thousands of employees in a specific region, in this case Oregon, the ripple effects will be all of these employees, thousands of them, they spend at restaurants, they pay rent, they pay mortgages, they pay for child care, they spend on their credit cards, they make car payments, and all of that has to be reduced or removed. Not to mention, of course, maybe relocation by some of these employees to find better job opportunities. This is going to be devastating for the Oregon's economy specifically. But you will see ripple effects nationwide because it's going to impact apartments, it's going to impact homes, it's going to impact restaurants, and many more. I think it's noteworthy to go back in history and give some lesson here to some of the younger viewers who were not trading during the dot-com bubble. The company Intel was one of the most promising companies on the planet. And as you can see, I'm highlighting here, in the dot-com bubble from the year 1995 all the way to the top of the bubble, Intel rallied by more than 1,500%. It was one of the hottest stocks in the world. And if I was a trader back in the dot-com bubble, and somehow I got frozen in time, and fast forward, I traveled to today's date, and you say to me that Intel is a horrible company, and the stock is trading where it was back in the 90s, I would not believe it, because Intel was the equivalent of NVIDIA today. It was the hottest company in the world. But look at what happened to it. This is what bubbles do. And this is what the brutal cycle of disruption in technology does. No company is immune. And if you make mistakes in a bubble and you continue to spend without really winning at the end, if your spending is misguided, you could see companies falling apart easy, disappearing, going bankrupt. Some of the best companies in the world, one day, they can go bankrupt the next day. A new class of companies take over. So keep that in mind. Now, the seventh and the last theme is the class divide, and this is really important. This can be found from American Airlines and Southwest Airlines earnings this week. Both of them were not pretty good, to say the least, and the stocks went down by 9-10% as a reaction. The headline reads, American Airlines warns of surprise loss. Southwest sees depressed demand as travel activity waffles. And you can hear here from the CEOs of both companies, they're all trying to avoid talking about the subject, but they can't mask it. They know that there is a massive weakness by the consumer. Take a look.
Thank you, Becky. Robert, thank you for joining us. You beat on the top and the bottom line for the second quarter, but it's the guidance that has the shares under pressure. Why such a wide range, everywhere from losing for the full year 20 cents to making 80 cents a share? Why the wide range?
Well, we're pleased, first off, with the beat on the second quarter. Team did a wonderful job in really challenging conditions, and so we're pleased with that. As we look out into the third quarter, it really is just getting the consumer, back in the game. The uncertainty that we had seen, certainly in the second quarter, really still impacted July to a great extent. We've got that on the books today, so we know what July is shaping up to be. It's not a great month, and then compounded with all the operations challenges make the third quarter difficult. But as we move through the third quarter, from July into August and September, we see domestic travelers coming back into this. And that's a good thing for us because American has a lot of our capacity tied up in that. And
this is, look, your stock is down almost 10% when you miss on the top and the bottom line, and then you have guidance the way you do. What are you seeing in the economy right now?
Well, first I want to say a shout out, our folks in the Network Ops Center, they do an awesome job running this airline every day despite weather. But so just got to say thank you to this team. But, demand was really tough. So we slipped about 6% from the beginning of the year, against what we thought. The nice thing is in the second quarter, demand stabilized on the domestic side. In the last month or so, we have seen the beginning of an inflection back. So, again, it's just the macro uncertainty, I think, that drove that. But again, the good sign is we're seeing positivity now.
Given the weakness we're seeing in the broader macro economy, and even though you're seeing stabilization now, do you need to cut even more capacity in the second half?
We've been the leader in managing capacity here. We've taken another 1.5 points out of the back half of the year. This year will only grow about 1 point. But really, the issue is getting the demand back.
Now, the important question is, why do we see American Airlines and Southwest Airlines doing horribly? On the other hand, we see Delta Airlines thriving. Delta Airlines, about a few weeks ago, came out and upgraded the guidance for the year. They see business rebounding. How do we square off this divergence between airline companies? The answer is the class divide. The reason why Delta Airlines is thriving, it's because of the affluent consumer, premium consumer, if you may, buying the first class tickets, swiping the Amex card because they don't really care. They want to score the points and pay later. They want a premium experience. On the other hand, the Southwest traveler is an average Joe and Jane, and we see weakness in their budgets. And that's what's happening right here. And it's a really important theme to understand, to see the class divide, which we've been talking about for months now, folks, in this channel. But here's your evidence. Delta Airlines last week reported 5% year-on-year jump in its second quarter premium ticket revenue, compared to a 5% decline in the main cabin revenue. So even in Delta Airlines, you see the class divide. The 10 percentage point gap was the widest since the pandemic, helping it boost or post a double-digit margin in the April-June quarter. Similarly, premium cabin revenue helped United Airlines mitigate the financial hit from operation constraint at Newark Airport near New York City, one of its largest hubs, and increased its earnings in the latest quarter. United's premium revenue rose 5.6% in the June quarter from a year ago, its overall passenger revenue grew just 1.1%. So you see the class divide even in United Airlines, which as an investor, if you must invest in the airliners, you got Delta, you got United. You can't invest in anything that caters to the middle-class consumer, like American Airlines or Southwest Airlines. Furthermore, airline executives have attributed the resilient demand for premium travel to the healthy financial conditions of U.S. households with earnings of $100,000 or more, which accounts for 75% of air travel spending. While an April sell-off in financial markets, this is really important for you to understand. Here it is, I'll say it again. While an April sell-off in the financial markets after Trump announced tariffs raised the risk of undermining that demand, a sharp rebound in U.S. stocks since then has eased those concerns. Delta CEO says that our core consumer is in good shape and continues to prioritize travel. So here's the relationship between affluent consumer spending and the stock market. If the big companies, the AI companies like the NVIDIAs, the Alphabets, the Metas, the Microsofts of the world, if they're doing fine, they can push the stock market index higher, despite what the rest of the market is doing, despite what the rest of the economy is doing. And that wealth effect causes the affluent consumer, which right now, behind about 3/4 of the entire spending in the economy. And if they feel pretty good and they continue to spend, then the economy and the markets hold. Even though we're seeing devastation happening in other businesses, other classes of the consumer. How long can this last? That's a long conversation, because the bubble, the AI bubble that is driving the stock market higher, has to be popped first. In my 2 cents, it will be popped because of competition. We'll talk about that in a separate video. But again, a reminder for folks who say that the stock market is divorced from the economy or the economy is divorced from the stock. No. The economy is the stock market. Without the stock market, we'll be in a depression right now. The only reason we're not and the economy is holding is because the stock market is at the highs, driven by a handful of companies, happen to be the biggest companies in the world. And because of the stock market performance, we see the affluent consumer holding spending in the economy. If you change that dynamic by popping the bubble, and we see the biggest stocks in the world going down, it doesn't matter if the rest of the market is doing good at that point. If the stock market index goes down, the response by the affluent consumer will be negative. And that's when the game ends. Continuing, trouble in the main cabin. In contrast, lingering uncertainty about the broader economy and rising living costs have taken a toll on demand from less affluent consumers. Bank of America data shows while spending by middle and higher income households held up in June, lower income households spending turned negative. So again, that's the theme from the economy. And in conclusion here, folks, again, we use the facts. No biases, no bullshit, just the facts. What are the bullish factors that we can extract from the earnings that we got this week about the economy? Number one, AI spending by large companies is still intact and increasing, and that's evident by Alphabet's earnings. Number two, the affluent consumer continues to spend, and that's evident by Delta's earnings. Number three, corporate consumer spending is still doing pretty good, and that's also evident by Delta. She indicated that corporate spending is also responsible for holding their margins. The bearish case, the bearish dynamics in the economy that we see from these earnings. Number one, weakness in consumer spending, evident by Chipotle. Number two, lower demand for travel by non-affluent consumers, evident by American Airlines and Southwest Airlines. Number three, weak government employee spending, evident by Hilton's earnings. Number four, tariffs lowering margins. That's a fact, evident by General Motors. Number five, housing market weakness. And of course, incentives depressing margins, evident by D.R. Horton's earnings. Number six, commodities inflation, as you see in meats, evident by Chipotle's earnings. Number seven, in the bearish dynamics for the economy, unemployment is rising, and that's evident by Intel. Number eight, weakness in domestic tourism, evident by Hilton's earnings. So now you know, you have a clear picture of what's going on in the economy. Next time you're sitting at the dinner table and folks say, all I hear is negative stuff about the economy, but the market is at all-time highs and it doesn't seem that we're in a recession, now you know how to explain that using the fact. By saying, look, the bearish dynamics, the negative dynamics in the economy are overwhelming right now. But the reason why we're holding is the affluent consumer, who now comprises about 75% of spending in the economy, is feeling pretty good. Why? Because the stock market is doing pretty good. Why is the stock market doing pretty good? Because a handful of companies happen to be the largest companies in the world, are still doing okay. They have plenty of cash and they continue to spend. And as they keep the stock market higher, the affluent consumer looks at their 401k and their investment accounts, feel pretty confident to go ahead and book some travel plans using Delta Airlines and spending at restaurants and whatnot. But underneath it all is unbelievable weakness in this economy. So there's one large block that hasn't fallen yet. Once it falls, it's game over. And now you know how to sound intelligent at the dinner table, especially if you want to impress some people. But this brings an end to this conversation here, folks. I hope you enjoyed the video. You found it informative. We'll be talking to you again soon. Take care.